Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
Hey, Byrne, why is it a bad idea to try to build another Berkshire? Or when we talk about what Buffett and Munger have built and what makes it so unique and perhaps non-replicable?
Yeah, so I think the Berkshire story is just an incredible business story. People will talk about the idea that a CEO's job is capital allocation, and that is ultimately true. Like in the long run, that is what they do. And Berkshire is just an example of how that can be done really, really well and can produce really good results in a way that's just incredibly hard to predict from the starting point. But it's also just a really complicated, kind of messy story where it literally Buffett's interaction with the Berkshire. It starts out as just kind of gaming. It actually, well, to rewind a ton, if you look at Buffett's early career, he talks about this a bit in some interviews and talked to the author of The Snowball about this. He did some things that were completely fine, normal, accepted at the time, and are now securities law violations. And a lot of those involved discussions with management about what we would now call material non-public information, such as, are they going to pay a dividend? Are they going to, what's the timing of a liquidation? Or are they going to do a tender offer for stock? And I think this was just kind of part of the market ecosystem at the time, was that you could talk to people and they would tell you these things, and they wanted to keep their shareholders happy, so they would give them this kind of information. And given that it was kind of widely understood that this was happening, I don't think it was unfair or anything, but that does set the tone for the start, the original Berkshire story, which is that Buffett had noticed that Berkshire Hathaway was gradually liquidating its business, that every time it sold off a textile mill, it would do a tender offer and buy back some stock. And he had talked to their CEO and had talked about this, and he had told the CEO that he owned the stock and that he would be happy to tender his shares at $11.50 a share, 11 and a half. And then a couple of weeks or months later, he gets a letter in the mail saying that Berkshire is doing a tender offer at 11 and 3/8. And he was just so offended that someone would lie to him over an eighth of a point per share that he started buying more and eventually kicked out the CEO and replaced some of the management. And the rest is kind of history, but there's still some messy history there. So it starts out as this kind of emotionally driven decision. And again, this is something Buffett has talked about subsequently. It was that even though Berkshire is this miracle of capital allocation, it started out with a poor capital allocation decision, which is, you probably should not be putting your capital into this dying company specifically because you're mad at the CEO. And also, if you are a really good investor, maybe spending your time finding these weird little corner cases where you can periodically make, your 5% in a couple months, and it's a really good risk adjusted return, but nothing that's a great return to get, but it's not super scalable. Maybe this stuff was already not a great use of Buffett's time, even when he started doing it. But either way, so he ends up in control of this company, which again is not a great business. It's a company where most of their factories are in the north, and they have competition from the southern mills, which are generally non-unionized, and labor is cheaper. They're starting to get competition from foreign operators. So not only is it not a great business, but it's a business that is going to steadily get worse. And unfortunately for him, it was also a cyclical business, and there was this cyclical upswing. So Berkshire had some extra cash on hand for a while, and he used some of that cash to acquire an insurance company. And then we start to get into the actual Berkshire story of Buffett is really good at sourcing cheap capital, primarily through insurance, but occasionally through other things, like much decades later, selling long-term out of the money puts to investment banks and just structuring things such that they can't demand they can't demand that he put up cash even when these puts rise in value, which was actually a good move. It was kind of using Berkshire's balance sheet in an intelligent way and taking what was a mispriced risk. So he did a lot of that stuff, but then in the kind of early days of Berkshire becoming what it is today, which is diversified conglomerate, lots of sources of capital, and owning lots of businesses that produce high returns on capital. In the early days, that did exist, but it didn't all exist under the same corporate umbrella. So Buffett had his hedge fund, which he wound down, I think, in 1969. And then he had a bunch of companies where he just owned varying interests in them and had various friends and partners who also co-owned different pieces of these companies. And he'd sometimes own the same entity through multiple parent entities. And at one point, the SEC looked at all of this and looked at some trading that Berkshire Hathaway and Buffett had done surrounding there was a bank where he had owned shares of the bank. The bank accepted, or the bank was entertaining a buyout offer that he felt undervalued the bank. Bank rejected the offer, and he was buying stock in the bank at a price really higher than he had to. And this was kind of a point of honor for him and for Charlie Munger, was like, if you tell management to do something you know is right for the company long term, but is going to hit the stock price in the short term, maybe the right thing to do is blunt the impact of that and also buy the stock because you know it's cheap. So it's, this nice synthesis of capitalism, like pure cold-blooded capitalism, and also this sense of personal honor. But what it also looked like to the SEC was, hey, we have this person who has a really complicated network of companies. They all have these weird cross shareholdings and things. And look, he's doing something that looks a lot like market manipulation. And I think by some definitions, probably was market manipulation. And I think it was socially benign. Like, it's, you don't really want multiple legal codes for different people. But I do think that if there's anyone who should have permission to periodically manipulate the stock market, it's probably Warren Buffett. So the SEC investigated him, and he had to produce just mountains of paperwork and had all these depositions and things, and had to answer tons of questions about his strategy. And fortunately, because his autistic special interest is business and investing, he actually just knew a lot of this stuff off the top of his head, and was basically able to clarify to the SEC that this was not some shady self-dealing shell game where he owns different stakes in different companies and they're all doing business with one another so he can extract money from it. No, this was just the most simple and direct way to build and expand his business empire, that he controlled different stakes in different companies. At any given time, there were different companies that had the most cash on hand and would be the company that could buy the next thing he wanted to buy. But I think he realized he just didn't want to spend that much of his life just dealing with depositions and talking to the SEC and explaining himself. And one of the ways to clean that up is just merge almost everything together into one holding company. And that's when we get modern Berkshire Hathaway, that it owns blue chip stamps and it owns a controlling stake in Wesco. And I think around this time, he also had to spin out a bank that he had acquired because there were new rules around bank holding companies, et cetera. So like there's a lot of complexity and messiness that makes the entire existence of Berkshire Hathaway as one company that is most of Warren Buffett's net worth, and that is where all that compounding happens. Like, that is a historical accident. It could have gone in a totally different way. He could have ended up just personally buying some of the insurance companies or something and building this empire that nobody else was involved in. And maybe he would have tried to allow some of his friends to invest in this entity. But like the fact that it is a public company is partly a historical accident. And then there's a long period from basically the 1970s to pretty much the present, where the Berkshire model is generate lots of cash from your existing businesses. They throw off more cash than they consume in almost every case. And some of that cash could be reinvested in those businesses, but a lot of it just piles up on the balance sheet, and he uses it to either acquire other companies or make investments in public companies. And this worked out really well. He's very, very good at that. But there were just a lot more opportunities to buy mispriced assets, particularly companies that threw off lots of cash flow. And now a lot of those companies, these are exactly the same companies that private equity firms want to buy. And these are also the companies where if a PE firm buys this company, when the fund reaches the end of its life, that PE firm probably wants to retain its ownership. They will probably put together a continuation vehicle and basically buy just that asset or just the highest quality assets and have this ongoing fund that keeps on owning them, because there are just not that many companies that produce sustainably high, predictably high returns on capital. And if you've got one, you really want to keep it. Like, you probably just should not sell it, unless someone makes you an insanely good offer. So he was buying a lot of this kind of company at a time when they were still pretty mispriced. And now there's just a whole lot more competition. Now there are a lot more companies that, like, a lot more potential bidders, and those bidders are a lot more sophisticated. They are thinking about the cash flow of these businesses. And one of the reasons for that is that Buffett wrote really, really good annual letters, and he articulated a lot of his philosophy. My understanding is that Carol Loomis, the Fortune journalist, did a really good job of editing a lot of these letters. So this is they are both very intelligent because it's Buffett explaining his investment process, and also really well written because Carol Loomis, who's a really good financial journalist, is also, tightening up the pros and things like that. So there's just a lot more people who understand that free cash flow matters a whole lot, and that you should think about how much capital a business needs to expand and all of this stuff. So just the space of interesting companies that he can buy has been shrinking a lot. And you can kind of see evidence for this in things like the fact that Berkshire Hathaway does more control deals where they actually take over the entire company. And I think one of the really notable kind of later stage Berkshire deals was the BNSF, the railway acquisition. And that's an interesting one because railroads and also the Mid-America Energy, the electric utility, these are companies where their return on capital is not that spectacular, but you can actually reinvest in these companies. You can actually put a lot of capital back into them and get some reasonably predictable return. So it did represent this change in the Berkshire approach where they weren't trying to just buy these tiny companies and harvest the cash flow forever. They were trying to find cases where they could continuously redeploy capital and have it grow within a given subsidiary. So the model of the business has slowly changed, and it is just a really good collection of assets, but it's also a collection that's just hard to collect. Like if you're looking for companies like that, you have to find the ones that PE firms didn't buy and that Berkshire Hathaway didn't buy and that are for sale. And that's really hard. So the reason this came up is that Bill Ackman, the hedge fund manager, has a company, Howard Hughes Holdings, which is kind of a sort of messy real estate development play. And he's been involved in it for a long time. And he announced this plan to turn it into the next Berkshire Hathaway, where Howard Hughes Holdings would sell a big chunk of stock to his fund at a price that was higher than the market price, but lower than the calculated value of the company's holdings. And then his fund would basically manage this business and treat it as a platform to slowly grow and diversify and create another conglomerate like Berkshire Hathaway. But I don't see any real reason that should work well. And I don't see any real point other than that it is a source of fees, just because the world has changed so much. And so many parts of the Berkshire Hathaway playbook they're part of everyone's playbook right now. So there just isn't the same edge that there used to be. And also, like, there were a lot of details of this proposal that I just felt were not incredibly well thought out. I'll put it that way. So one of the things he said was that he thinks that Howard Hughes Holdings is undervalued by the market, that the market just doesn't understand the business, and that it's going to trade at this persistent discount, and they need to fix it. And this is the way they want to fix it. But if one of the problems with this business is that it's too complicated to understand, the solution to that is probably not to make it even more complicated. Probably the solution is to make it less complicated. Like if you slowly liquidate the business and just buy back the stock, if you are correct that it's undervalued, then that's very value accretive. And the shareholders who correctly agree with you that this stock is underpriced and that all this complexity means that people are just not putting a high enough multiple on the cash flows that the company generates, well, they get to be along for the ride, and they get the benefit of the underlying value of the business compounding and of the company buying back its stock at less than that value. So you get even more per share compounding. That's kind of the, again, pretty standard operating procedure for a lot of companies whose management thinks that they're undervalued is, okay, stop reinvesting in the business. Like if you have $1 that you can either use to buy $1 worth of assets that you think the market will actually value at 90 cents, or you can buy back a share of your stock and you pay $1 and you think that it's worth $1.11, same degree of undervaluation, then of course the thing that accrues more value to your shareholders is just buy back the stock. So that the problem with that, though, is that if you are charging a fee on the assets that you manage and every year the asset base shrinks as you buy back stock, then your fees tend to decline. And so that kind of loops around to another thing that is distinctive about Berkshire Hathaway, which is that the way that Warren Buffett got rich mostly was that he charged a fee, which I believe was get a 4% hurdle rate, and then he would take 25% of profits above that hurdle rate, and he invested most of his net worth in his hedge fund. So he made money by being completely along for the ride with shareholders. He was taking 100% of the losses when, he was right aligned with them perfectly in the sense that if he lost 10%, for his investors, his net worth went down about 10%. If he made money, he made a bit more than they did. That was compensation for the fact that he was managing this portfolio. And then when he switched to Berkshire Hathaway, his income is just 100K fixed salary and some corporate perks, and then that he owns a huge chunk of the stock. And so when the stock goes up, he does well. And that's a nice incentive alignment. It is actually something that I think a typical corporate governance expert would say it means that Buffett is underpaid, that he should be getting, a large performance-based stock options grant and should be getting some other way that his performance gets a little bit juiced. So he's not just getting return from owning a big piece of the equity. But I think if you are looking at things that are unique about Berkshire Hathaway, if it is no longer the only company that is trying to buy out cash flow generating businesses, if it's not the only company, like every PE firm is this cross-sector, massively diversified conglomerate in effect. So that's no longer unique about Berkshire Hathaway. The actual unique thing about Berkshire Hathaway at this point, other than the specific assets they own and the talent of the people in that business, the really unique thing about them is that they don't charge carried interest. That if the company's value goes up, the management team does not get a disproportionate cut. So if you do want to recreate Berkshire Hathaway, the thing you can do that is actually unique and differentiated is get paid less. But that's, I'm not in a rush to find a way to replicate that part and only that part of the Berkshire Hathaway model myself. I can understand exactly why someone would want to try to create something like this. I just don't think it's a very good idea.
Hey everybody, Erik here with a word from our sponsors. What does the future hold for business? Ask 9 experts and you'll get 10 answers. It's a bull market. It's a bear market. Rates will rise or fall. Can someone invent a crystal ball? Until then, over 41,000 businesses have future-proofed their business with Netsuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. When you're closing the books in days and not weeks, you're spending less time looking backwards and more time on what's next. If I had needed this product, it's what I'd use. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/102. The guide is free to you at netsuite.com/102. netsuite.com/102.
And how do you think, what's the Steelman response to it? The argument that you just made, someone listening to this who believes that it's worth doing, what would they say?
So I think the Steelman response, and this is probably true, is that Ackman and his team are really good analysts, that they are able to identify interesting opportunities in public markets, and that skill set maps very well to identifying good opportunities in private markets, that sometimes you do just want to be the high bidder for some unique asset that is only going to go on the market once because someone's going to buy it, they will never sell it, and you want that to be you. So it could be the case that is true, that there are companies out there that PE firms are not in a good position to analyze, and that Howard Hughes Holdings and the Pershing Square investment team is in a good position to analyze. They are really sharp people. They've made some exceptional calls in the past, and they also do run the business a lot more like Berkshire Hathaway. They run their portfolio a lot more like Berkshire Hathaway in the sense that they have these large concentrated positions in pretty big companies. So yeah, there is some direct mapping there. But I just think it's not so much that this is even a terrible idea. It's that I really don't like them pitching it as potentially the next X when there's only one X and it's distinctively X for a reason. I think that, if you what you really want to do is you want to build a kind of company where people only start calling it the next Berkshire Hathaway in retrospect because they realize that that's what it's evolved it to. If I were trying to identify modern companies that I thought had really replicated part of what made Berkshire Hathaway special, I would actually point to someone like Constellation Software. So they're this Canada-based company with a really great model where they just identify small but indispensable software companies in very narrow verticals. They buy them out and then let them operate pretty independently and pay really close attention to the financials. And typically they do what everyone who buys out small, low growth software companies does, which is they just figure out, they continuously raise the price and figure out at what price point customers would actually want to switch, which is often much, much higher than the price that customers are paying. So that's been an amazing business for shareholders and is a really good model. But it has once again run into the problem that a lot of people have read the excellent Constellation Software letters, and they have looked at the stock chart and they've seen what amazing results you can get from buying these indispensable niche software companies. And so now when Constellation wants to buy one of these companies, there are a lot of other bidders. And meanwhile, they've done so well at this model that they have a very large asset base. And so if 10 or 20 years ago, it was actually really great for them to find a company doing 10 million a year in revenue, 4 million in EBITDA, and they think that EBITDA could be more like 5 million, and that revenue could be growing at 7% instead of 2%, et cetera. Like they used to find a lot of those opportunities, and those opportunities used to be pretty meaningful for them. But now, if they do that, they're a pretty sizable company. Let's see, market cap of $100 billion. So when you find that extra $5 million in EBITDA, like your shareholder base is not actually even going to notice that you made that acquisition, even though it's a good value accretive acquisition. And then they can go larger, and they've had to flex their model a little bit because they've just run out of these good opportunities. But I think that is just that's the curse of any kind of investment business, is especially if you are a buy and hold investor, is that eventually you are holding all the things you'd ever want to buy. And there's a finite supply of these things. You own them all. I used to visit the business school library of Washington University in St. Louis, and I would read through old issues of Forbes and Fortune from the 1960s, 1970s, et cetera, just to kind of get an understanding of what business was like back then. And I remember reading this profile of a mutual fund manager, and he apparently, his habit was to call up brokers and say, okay, I want you to give me a list of every company in your coverage universe that's growing at least 10% a year and trading at less than 15 times earnings, or something like that. He had some really straightforward screening criteria, and this was back when you couldn't just go to a free stock screening website and get a list of all of these companies. And at one point, the interview, or the profile says that at one point he called his broker and said that, and his broker said, okay, well, Fred, you own them all. Like every single company that fits your criteria is in your portfolio. There are none left. And this actually happened to Buffett early in his career, where part of the reason his returns were so good especially in the 1960s, was that he was buying small companies, low PE ratio, lots of assets on the books. And there was actually another buyer for those, which was the conglomerates, because what conglomerates would do is they were diversifying into a bunch of unrelated industries, mostly to avoid antitrust scrutiny, and also because the accounting made that look like a really good strategy. But what this meant was that if you had a company that had a low PE ratio, you had a natural buyer who was very excited to take it off your hands at a premium, because if they are, let's say they're trading at 30 times earnings, they buy something at 10 times earnings, they pay for it entirely in stock, their earnings per share just mechanically go up. And then they get this nice chart showing that our earnings per share have compounded at 20% a year. And if you actually walk through the math of what the impact of acquisitions was and what the organic growth rate is, you'd sometimes find that, okay, these companies are actually buying not very good companies. They're running them even worse than they were run before. But as long as their stock is still expensive, it does make earnings per share go up. So the fact that these conglomerates existed and were so voraciously acquisitive meant that anyone who owned a portfolio of small, cheap stocks was constantly getting offers lobbed at them that were often for more than that company was probably worth. But it also meant that after a while, the conglomerates owned all of these companies, and then a lot of alpha was generated, a lot of carried interest was accrued in the 1970s and 1980s by unwinding that exact process. So you'd find some big conglomerate that had, they started out in electronics, and then they bought a steel mill, and then they bought an aircraft manufacturing company, and then they bought a meat packing company. And you'd look for which of those things can they get rid of, because these things don't actually make any sense together. You buy some of their subsidiaries on the cheap, you take them public as this lean, focused company where the CEO has a lot of stock options and is very, very focused on making sure that the company grows and that earnings per share keep rising. And you have this nice tool for dismembering these companies at a favorable price and then selling them to the public. And now we do have fewer just totally industry agnostic conglomerates. There are conglomerates out there, but they're often conglomerates that focus on either some sector or sometimes some niche within a sector, where they can be a little bit agnostic about the specific things that companies do, but they have to have a really good sense of what kinds of businesses they're actually good at evaluating and good at managing. It's not enough to just have a high multiple on your stock and buy stuff that's trading at a lower multiple. So yeah, you've got like all these random contingencies and things that just make it really hard to ever repeat financial history in any meaningful way. And when you abstract out the patterns, one of the things you find is that people who are directly trying to repeat financial history, especially trying to repeat successful financial history, the best that they can do often is gather a lot of assets, but usually that financial, like the really outlier returns came from one, someone actually having a good strategy, but two, executing that strategy at a time when there were actually really serious tailwinds that made it perform disproportionately better. And Buffett, to his credit, is actually like one way to read his career is that he's, among other things, the world's most successful factor timer, because he was long small cap value in the 1950s and 60s, great time to be long that, and then slowly shifted his portfolio to being long quality and like high margin companies with high returns on investment. And they also had a really spectacular run from the pretty much early 90s through the present. That has been a really good space to be long, regardless of which specific companies you pick. So, you can say that, okay, he did this factor timing thing and got lucky every time. What you could also say is, no, the factor timing thing is actually an output, like an accidental output of what he was actually doing, which was just looking for the best opportunity to compound his money. And he did eventually find that small cap value, as these stocks do better, increasingly the companies that do qualify as small cap value are all in the cheap for a very good reason basket. And that meanwhile, when you're looking for what can compound your money the fastest, finding Coca-Cola trading at 10 or 12 times earnings when international is growing quite fast and the US is still growing at above inflation, and you're growing units and you have pricing power, et cetera, like that is just it's a better way to make money. It's a whole lot easier to make money by just continuing to hold Coca-Cola stock than by digging through 310Ks to find which tiny, barely profitable Midwestern machine tool manufacturing company secretly has like an overfunded pension. And when they get acquired, they're going to realize the value of that pension. And until then, it's just dead money for 5 or 10 years. That's a tough way to make money. There are still people who do it. There are people who do it well, but it's grueling. You end up basically in, to the extent that you think of owning stock as owning a piece of a business, which is a really good abstraction for thinking about it. If you're a buy and hold investor, you're in business with people who are running these kind of tiny, mediocre companies, and the companies are not doing that well. So it is some combination of unlucky people and untalented people, and then a handful of people who are just really passionate about what they do. But this is another case where Buffett had these secular tailwinds behind him that I don't think he would have explicitly identified, but which definitely helped him out, which is that the US was just a much less talent stratified country in, say, the 1950s than it is today. We just didn't have nearly as many institutions that are looking for all of the brilliant people and trying to funnel them into the exact same set of schools and then the exact same set of white collar jobs. So there were a lot of cases where someone just through dumb luck, like the person who, if they'd been born in the 1980s, would have definitely gone to Harvard, definitely gone to Goldman, definitely gone to a PE firm, and just would have rocketed up in their career trajectory. Instead, it's like this person finished high school, which is what you do, then got a job, which is what you do. They're really good at their job because they're smart and hardworking and all that stuff. And so they end up running this company. And so you have these random companies just in the middle of the country that were actually run by really, really sharp people because there wasn't this relentless pressure on the part of other institutions to find these people and pay them a lot more to go do something else. So you had basically an inefficient market for talent, which meant a lot more obscure companies that were really well run. And now a lot of the really well-run companies are the companies that you kind of expect to be really well-run. Like they are either really important or really high margin, and they can afford to be the high bidder for talent, and there's more of a real market for talent, so they get that talent.
Zooming out, is reverse engineering a successful strategy usually a bad idea? Or how do we think about a litmus test or framework for understanding, when reverse engineering can be effective versus when it's sort of flawed on its face?
Yeah, like I think the right way to think about it is if you want to copy an institution and that institution was created within one person's lifetime. So it's not like if you want to copy Harvard, you have to start 400 years ago. But if you want to copy Berkshire Hathaway or Google or Facebook or OpenAI, like you can start doing that now and have at least, a logical possibility of actually getting something like that done in your lifetime. But the thing to do is immediately to ask yourself, what would Sam Altman do in my circumstances, and not what can I do to start an AI company and build a really, really big LLM? Because that's probably not what he would have done at that time. And we know this because when he started OpenAI, it was just not that hot a sector. It was kind of, well, it was kind of in this weird indeterminate state where big tech companies were talking about AI, and there were still jokes about how if you are getting a PhD in computer science, if you turn your dissertation into a startup, you get this, you go to work for the same company you would have worked for anyway, but you get this multi-million-dollar hiring bonus because they acquire your business instead of just hiring you out of school when you graduate. So like that kind of thing was kind of in the air. So maybe the hypothetical Sam Altman, who is 15 years younger and just getting into this stuff, maybe he does start something pretty similar. But what he actually started initially was a mobile social network. And that was a kind of hot sector, but it was also a sector where things were changing fast enough and there was just enough uncertainty about how things would shake out. Like this was, I think when he started the company Looped, it was pre-smartphones slightly, if I have my history right. So he had to do a bunch of deals with mobile carriers. And this was actually a reason that people weren't starting companies like this, was that if you wanted a social network that people would use through their phones, you had to go find someone at Verizon who would let you put this on Verizon phones. And that's just a lot harder than downloading an SDK and writing some code and uploading something to the App Store. So there were a lot of barriers to entry there. So I think like maybe the approach is you look for a set of problems where the barriers to entry are so high that you are probably a lot of the talented people with reasonable risk reward trade-off functions are just not competing with you, in which case you're either competing with people who are totally deluded or basically people who are totally delusional are your competitors. And then you have to underwrite the risk that you yourself are totally delusional and that everyone you're competing with is making exactly the same calculation you are of, hey, all the smart people think this problem is too hard, so I'll have no competition, when the actual outcome of that thought process in most cases is all the smart people think this problem is too hard because they are smart enough to realize this problem is too hard. So that's why they don't do it. That's why I won't do it. Like this is like you implicitly reject the vast majority of startup ideas that you could actually execute on for some reasoning process that's basically like that. So yeah, if you're trying to recreate an institution, trying to recreate the thought process of the person who started it and trying to look at the opportunity set the way that they would have looked at it, almost always means you do something different from what they did. Or to the extent that you do the same thing, you're probably thinking about it in a different way. So like when Warren Buffett started a hedge fund, it was a kind of weird thing to start. It was just this kind of quirky edge case in securities law where there was a way to run an investment vehicle and get paid an incentive fee that was a share of compensation. I think one of the reasons he might have known about this and done it was that I think he'd read Benjamin Graham's book, The Intelligent Investor, and really wanted to work for Graham, ended up working for Graham for a while. And Graham had one company that was basically a closed-end fund. I think he also had a partnership that was basically organized as a hedge fund. So Buffett did have some exposure to this legal structure and was able to implement it. But when he did that, I think he was thinking of this as just a way to pool some capital and do some of the same strategies he was doing personally, but at larger scale. And then he grew it from there. But I think if you're looking at a hedge fund now, you will probably be thinking about it as the fastest way to really scale up your assets. There is just a much more efficient market for talent, where if you are managing money and you have audited results and your risk adjusted returns look good and you can explain your strategy, there are people who are constantly looking for investment vehicles that fit those criteria. And in 1954, there's basically nobody out there who's saying, I really, really want to find someone with a high Sharpe ratio and a differentiated strategy so I can allocate $50 million to them. That's just not something people said in the Eisenhower years. So even if you decide, okay, I want to be like Warren Buffett and I want to start a hedge fund, you're actually doing something qualitatively different from what he did at that time. It would be a lot closer to saying, I guess it's a more mainstream financial product. It's a better understood financial product, and it's also a much more competitive space. I think like the next Warren Buffett thing to do is probably find an asset class that is so obscure that people don't even think of it as an asset class and start trading that and then scale up from there. But even I guess that does illustrate one of the problems with trying to emulate famously successful people who did something way before it became a mainstream thing to do, which is that you can describe it at a high level, but when you describe it as find the thing that nobody even thinks of as as an entry on the list of things you could hypothetically do with your time and talent, where do you go from there? It's not really action guiding to say, make a list of things smart people do and then pick something really smart to do that's not on that list.
I want to talk about another aspect of Buffett, which is his brand, right? His kind of understated, Omaha sort of, that, Midwest aesthetic. I'm curious if he was coming up today, given sort of how our information environment and social media works, if he would have maybe a different brand. If you could even see the change in Elon and Zuck's brand in the last, 10 years, and think about that as a product in the environment too. But just also in general, it's interesting to compare just sort of the, different billionaires or people who reach that, level of wealth and influence sort of approach. Some have a more brash style, like Elon, who I mentioned, and others like Gates have more of a reserved, old world Davos style. And so it is just interesting to compare and contrast sort of the different aesthetics or brands and how they work with their business models as well.
So I think one thing with the Gates brand is that I think my understanding is that the internal Bill Gates brand within Microsoft was actually pretty brash and combative. Like his catchphrases were things like "That's the stupidest thing I've ever heard," but his other catchphrases were things like "We hire for IQ." So if you hire the smartest people you've ever met and tell them this is the stupidest thing you've ever heard, that implies an extreme level of confidence in your own ability. And if you hired someone to write a compiler and he tells you what he's going to do with his compiler, and then you tell him this is a really stupid way to write a compiler, you have to be extremely confident in your just software generalist and technologist abilities. So I somewhat wonder how much of that Gates brand is kind of a creation of his PR strategies. And I do miss the 90s just hyper aggressive Gates. I understand why that Gates is not really available in public life anymore, but I think it's a cooler character. I think on the Buffett brand, it is true that he has passed up many opportunities to maximize short-term gains, and he's done so in a way that does maximize long-term gains. So if Buffett and KKR are both in the running to buy some fifth generation family company, and Buffett says, we're going to preserve your legacy and we're going to make sure that your great grandkids are very proud that the family name is still on the business, and of course it will be on the business, and we're not rebranding, and we won't do mass layoffs and all that stuff. If he says that, and also a 31-year-old VP VP at KKR who went to Penn and worked in investment banking for a while, also says that, one of them is just a lot more credible than the other. And I think that is something that's been valuable to Buffett. I do wonder how much of that is like, some of that is just a deliberate PR creation. Buffett could have written shareholder letters that were just like every other shareholder letter. He did not have to have the personal stories, not have to have the jokes, not have to have, a like arbitrage 101 explanation, things like that. He didn't have to have the weird sex jokes. He could have omitted all of that and just said, we're updating shareholders on the performance of this large conglomerate, and maybe given it some more generic name like Enterprise Holding Corporation or whatever, which is probably much more accurate a descriptor than naming it after two defunct textile mills when it doesn't actually operate in that business anymore. But some parts of Buffett's life do just make more sense if you think of him as someone who was clearly on the Asperger's spectrum and grew up at a time when that set of traits was not really well understood. And so things like being located in the Midwest and always living in the same home, like that stuff is kind of humble and unassuming. It is also stuff you do if you live very much a life of the mind and you have your fixations, you spend all your time on them, and you are really, really attached to routine. So I think some of that is less about affable, normal Midwesternness and more that sometimes people on the autism spectrum eat the way they ate when they were 6 years old because they formed these habits and they really, really don't want to change their habits. And similarly, living in your hometown, it could be an unassuming thing where you just say, I don't like these city slickers in New York. On the other hand, he spent plenty of time in New York. He traveled a lot in his career and had vacation homes and had friends all over the world and was hanging out with powerful business people since like the 1970s. So to some extent, it is an exaggeration to say that he is just like every other unassuming Midwesterner. He's very different, but does happen to pattern match to that in a way that I think is actually good for Berkshire. It does mean that they are the preferred, they're the bidder of first resort, and that probably means that they can pay a little bit less. And I think that Buffett is probably both happy that he's done business in a straightforward way and played by rules and done the honorable thing, and also happy that he can bid 9.5 times EBITDA and the private equity firm bids 9.7 times and Buffett still comes away with the deal.
Just on the Gates point, I'm surprised Gates hasn't brought back some of that old energy, given that it seems to be fitting the times to some degree. And it doesn't seem like his recent strategy has done well for him, at least in the past couple of years or since COVID. It feels like he's had a bit of some PR challenges.
To some extent, I think he got backed into a corner because if you have this combination of you're clearly smart and everyone knows this, you're also pretty arrogant and you kind of you've earned that, but you are really arrogant and it's hard for you to hide it. And then your company gets into legal trouble and you are this sort of evil empire and your products are widely distributed, but it turns out that they were written for a very different security environment where viruses could not just traverse the entire graph of all computers connected to the internet, all of which are running the same operating system, etc. Like, I can see why the actual, piratical wealth maximizing hyper arrogant thing to do is pretend to be humble, start wearing sweaters, and to start talking about your favorite books and curing diseases. I think it's hard for him to recapture that kind of thing, and I think at this point, because he has been a philanthropist, a full-time philanthropist for decades, I think he just wouldn't be able to get away with it. It just people would actually think he was faking it if he behaved the way that he naturally behaves, which is kind of tragic. But I think this happens to a lot of celebrities. It is a form of audience capture, but I suspect that on the inside he is still rolling his eyes and thinking to himself that something is the stupidest thing he's ever heard, even if he's no longer in a position to say it.
Right. It's funny how even the average person just doesn't trust him or something, who's unaware of the Microsoft history. Like my personal trainer was like, what's he doing with all that farmland? It seems very suspicious. And so, some people, maybe the more brash, they seem more honest or something. And people who are humble, it seems fake often.
I mean, if someone is famous and humble, they're either really, really humble or they're faking it. And it's just more likely that they're faking it to some degree. But also, I suspect that the way to have a public brand is probably not just make a list of the traits that you think have the highest ROI. It is to take, list like 20 adjectives that describe you, pick 3, and then exaggerate those 3, but exaggerate them in the same direction that they actually are. So if you are somewhat arrogant, act really, really arrogant. If you are somewhat nerdy, be really, really nerdy. I think that kind of thing works because we just, in our brains, we don't have room for really complicated, elaborate mental models of that many people with whom we have parasocial relationships. You generally don't have just fanatical, detailed knowledge of the lives of dozens of celebrities or business celebrities or whoever else, even if you do have some where you've read a lot of their stuff and are really familiar with their work and kind of have some view of what they're like. So just, as kind of a courtesy to your fans, if you just ignore some aspects, like you downplay some aspects of your personality in public and then exaggerate some other ones, it becomes easier for them to slot you into their mental model of the world, and then they're more willing to pay attention to you.
One quick last anecdote on Gates I'll share is that, usually when I hear really impressive people of that nature who haven't been running their businesses for a long time, sort of, I won't name names, but speak with startups, those kind of just resort to platitudes, and because they're so far removed from actually running a business or the spaces that the entrepreneurs are running. But at my old venture firm, we had Bill Gates come in and talk to 5 of our startups, all in different spaces, and one-on-one meetings we would watch. And I was blown away that Gates seemed to know more about the industries like agriculture, biotech than the actual founders. And I was just blown away at the level of, so he's definitely not faking his brilliance. I mean, it's pretty amazing to see.
Yeah. If you are just genuinely interested in business and technology, and you read about it because it is intrinsically fascinating to you, you will just keep accumulating information. And probably reading a lot is pretty good for just keeping your working memory healthy and keeping your general memory healthy. And especially if you're reading history, there is this compounding effect where the more data points and more mental models you have to hook things onto, the more memorable different things are. Like you can kind of construct more of a coherent timeline. Like it took me a while to put together this connection between Buffett was buying lots of value stocks in the 1960s and that the conglomerates were growing in the 1960s. Like putting those together and realizing, wait, the conglomerates are growing by buying exactly the companies that Warren Buffett is buying. And so this probably added, a material amount to his returns over that time period, but also meant that it exhausted the set of companies he could apply that strategy to pretty quickly. It takes a while to put those things together, but then both sides of that are a lot more memorable. And you can kind of connect the idea that Buffett winds down his fund at right around the same time that the conglomerate bubble peaks. And that the early 1970s are just a totally different market environment. Like all of these things are more memorable if you know more stuff. And so if you're someone like Bill Gates and you've been just reading avidly for many decades, then yeah, you actually probably do have a lot of useful background knowledge. And I'm sure when he started, because I think when he was at Microsoft early on, he was just all Microsoft all the time and had to set aside specific chunks of the year where he would do something other than just the day-to-day Microsoft stuff. So if you I would imagine that early early on when he actually had time to just unplug a little bit and read more, he was probably just comparing literally everything he read in business history to the early history of the software, PC software business. And I think there's an anecdote from one of the early Gates biographies, and this is the 1994-ish one. Stephen Maines, I think, is the author, where where Gates was reading about Henry Ford. And actually, the auto industry does have some interesting parallels to the software industry. But I think if you spent a big chunk of your professional career in one industry and then you read about another industry, everything is either this is just like software, only more so, or this is, these guys really don't know how good they had it. It's so much tougher in software, or wow, like this is actually a really challenging thing. I'm glad I never had to deal with that back at Microsoft. But then you read the next industry, and at some point you reach this point where you realize that, hey, forestry is actually a whole lot more like railroads than it is like software. And so now I have this other bank of metaphors that I can use. And then you're building up this whole cluster of interlinked concepts. And that just makes it a lot more straightforward that when you find the next industry, you have a bunch of mental models that you can start configuring, and you sort of build your Lego, your like industry Lego out of all these different pieces that were already in your collection.
Yeah, I feel like you're one of the best in the world at doing that. Yeah, it is interesting. I mean, whenever I hear Gates on anything technology or business, and those are very, there's a lot that goes into those topics. Obviously, I'm pretty impressed. When I hear him talk about politics, I'm not super impressed, and maybe of course that predisposes my biases. But I think it gets to this bigger idea of like, some people refer to this concept Gell-Mann amnesia or Gell-Mann amnesia. This idea of, and sort of the idea behind it of like, hey, you read something in the newspaper and you kind of take it at face value, and then you read something that you know about in that same newspaper, and you're like, wait, this newspaper doesn't know what they're talking about, yet you don't provide that same level of skepticism to the other things. And it means to imply that, hey, if they're wrong on what you know about, they're likely wrong on other stuff too. But I wonder if we over-index on that a bit too much. Like, if someone has is dumb on politics or dumb on some topic, like people, because he's very like my friend Balaji, people will say, oh, this person had this crazy prediction, thus like everything says right. But if you're in the business of hot takes, or if you're a thinker and you think about lots of different things, sometimes you're going to be sort of biased on another, example is, and of course this is a controversial topic. My friend Amjad is, very passionate about the Palestinian issue. Obviously he's Palestinian. I'm Israeli. Obviously I disagree with him on that topic, but I think he's brilliant. And I don't take away, like, just because has a perspective on this issue doesn't take away from his perspectives on other issues too. I think we're too quick to input the opposite. Like, it's very, people say don't meet your intellectual heroes because often they have like one area in which they're, mistaken. Of course, that specific issue is a matter of opinion, and values. But yeah, anyways, it was just a reflection I had.
No, I think that's true. And it is, you'd think that it would be, the people's politics would be a lot more predictable from what field of business they're in, and, like what they do and what kind of thinker they are in other domains. And it's just not true. Like, you can, if you read a description of someone who is obsessed with functional programming and loves, basically programs by coming up with a category theoretic model of the problem and then implements it in, solves everything in like 3 lines of Haskell or whatever. Like, you know that this person is either a revolutionary communist or a literal fascist, but you don't actually know which it is. So I think that the right mental model is that the more of an outlier someone is in terms of their career and their career success and success in some academically weighted field, the more high variance their views will be on politics and philosophy and religion and diet. Like, you know, they will have some really out there weird stuff going on in some domain of their life, but you don't really have a good prediction of what it'll be. And there are these weird things that loop around, like the stereotype of the Rust language is that it is, full of communists and anarchists and people of like very quirky left-wing views. And then Rust is really popular in the crypto space, where the stereotype, which is pretty accurate, is a lot of them are anarcho-capitalist is sort of like the left wing of crypto politics, outside of like people who are actually trying to get the US government to do something for them. So yeah, so like these two clusters that are at polar opposite extremes happen to collide together. So yeah, it's just incredibly hard to predict what someone's views will be. And I think what that ends up doing is it means that we actually end up being pretty pluralist, because there's very, very little upside to politicizing, there's very little upside to bringing up politics or religion or diet or whatever in a hostile way. There is some upside in just having an earnest conversation with someone whose views strike you as completely insane, because they will turn out to know things that you don't know. You will turn out to know things they don't know. You will both end up more informed and also somewhat perturbed and kind of questioning each of your worldviews. Like, that's the ideal. But it is definitely true that there's a lot of political variance at the tails of achievement, and it's also really hard to predict what it will be.
Yeah, totally. Maybe before we go, one last question for you, which is Dorkesh's interview with Satya. What was a big takeaway or something that struck you? One was about your comment, or his comment around how when the real benchmark for AI's impact will be when GDP growth is at 10% annualized.
Yeah. Yeah, which I thought was, I think, throwing out a number like 10%, like I wrote a bit about that because I thought it was an interesting hypothetical. It is kind of a brain stretching question to say, what if it were a regular occurrence for growth to be faster than it is, like if growth in the developing world were faster than it is even coming out of a deep recession, but also not so fast that we completely throw the rules out the window. So, 10% growth is just, we achieve the economy of 2030 by next year and the economy of, 2035 by the year after that, based on the normal trend line, which is something that I think is pretty impressive, but also it's very comprehensible. If you step into a time machine in 1995 and you come out in the year 2000, there's a lot of stuff that has changed, but you don't need that many things explained to you. You have heard of the internet as this new weird thing, and now in some ways it's a lot more common, but in other ways, actually, internet penetration by 2000, I think it was still on the order of like 20 or 30% or something like that. Like, it was actually not, or at least broadband penetration was even lower than that. So like, it wasn't as transformative as one might think. And so I think that pace of growth would be really, really high, but not so high that it completely unravels society. And the main thing I wanted to write about that was just, okay, let's say we are actually producing that much more. What do we actually spend that on? Where does that surplus money go? Now, it would be a differently interesting world if GDP growth were 10% a year and basically all of that incremental growth was data center capex and, R&D for the next generation of GPUs, or if a third of the economy consisted of people typing in answers to help LLMs correct edge cases or whatever. But just looking at how consumption patterns shift, I think is a helpful exercise, because there's plenty of data on how consumption patterns change in developing markets, which is basically when people go from subsistence to not subsistence, pretty much the first thing they buy is shoes. And then once everyone has shoes, then you start kind of expanding from there. Like, maybe someone gets an electric bike, and of course people start buying Android handsets and so on. And then there's a level of GDP where most people will probably buy a car, and there's a level of GDP where they buy certain appliances. And then as you get richer, a lot of the incremental spending is on healthcare and education, the fields where it's just very hard to drive durable productivity growth. But There's also this other category of spending, which I guess so there is a term for it, which is a premium mediocre. So this is from the Ribbon Farm blog. And premium mediocre is, it's stuff that is not excellent, but is actually just reliably pretty good. And I think Chipotle is the classic example of this, where Chipotle is just better than most of the fast food that you can buy and is pricier than most of the fast food you can buy. It's not an exceptional meal. Hopefully, it's not the best Mexican food you've ever had, but it's also very predictably better than average food, and you know exactly what it'll cost. And I think that a lot of above average economic growth for a country as rich as the US involves just expanding the scope of premium mediocre options in dining and also in entertainment. In terms of physical goods, it is hard to think of what the next category of those physical goods would be, because there are a lot of cases where, we could have flying cars, we could have much faster, more efficient public transportation, etc. That's not really gated by technology. There are not technological constraints that make it really hard that make California high-speed rail both incredibly expensive and also non-existent. And also, at this point, my understanding is that it would also not actually be high-speed rail. Like, the political constraints have been such that it has a lot of stops, and the route does not actually make sense for rapidly transporting people from one big city to another big city. So like that's not really a technological constraint, and it's very likely that at higher GDP growth and given no institutional changes in how politics is done, that by the year, if GDP growth is 10% a year, there will at some point be like $1 trillion high-speed rail project that is going to build high-speed rail between New York and Chicago, and it will never get built, and it wouldn't be high speed if it were built, but it will create a vast amount of paperwork and a vast number of sort of jobs. But actually, I think the premium mediocre thing is the thing to bet on, is that you will have access to things that are like 70th percentile quality, and everyone will be able to get them, and there will be variants on that for every possible preference that you could have. So there will be like Chipotles for 50 different ethnic cuisines, and they'll all be delivered by the same set of delivery apps, and you'll be pretty much satisfied with it, even though it won't be amazing. And I think there is sort of like this Fukuyama-esque end of history thing, where what if, like, is that really the end state? Is that you can have generically good food of any kind you want that is delivered quickly, and you'll occasionally get a coupon because DoorDash is trying to bump up their retention numbers or something? Because that also does price out the actual unique, distinctive stuff. Like, it is very hard if you are in a town that could support 1.5 Mexican restaurants and then Chipotle opens up a location there, you're probably like, the other Mexican restaurant is probably going to be out of business in not too long. So it does mean losing a lot of the interesting parts of the economy and interesting parts of life, but it is also like that is what economic growth is that you have fewer craft industries and a lot more mass production industries, and that things get cheaper, and the quality bar for the cheap but ubiquitous thing keeps going up, and pretty much everyone can afford them. And that's it. That's actually, in terms of material prosperity, that's pretty nice. And it probably does mean that it's just, leading a life that is not a premium mediocre life will involve more and more willpower, because it will be easier and easier to afford lots of generically nice little treats. And so, if that's what you're into, you'll be happy. If you find that really revolting, you will probably have an unpleasant time, but you'll find one of those Chipotle-esque things that you actually really like.
We'll close on this inspiring notion that, we wanted post-work utopia, and we got 50 different Chipotles, premium mediocre for everybody.
I think it'll happen. Chipotle's good.
Yeah. Yeah, exactly.
It's not the best, but it is good enough, and you know exactly what you're getting. And that is what economic growth is good enough. Everyone can get it. They know exactly what they're getting, and there's more of it and more variants of it all the time.
On that inspiring note, Byrne, as always, great discussion. Until next time.
Yes, indeed. Talk to you next time.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.